Today, we're back with Unintended Consequences, episode 52 for July 8th, 2026. Every story we cover starts with someone who had a reasonable plan. The Federal Reserve launched quantitative easing to rescue the economy from another depression, and ended up widening the wealth gap for a decade. On November 25th, 2008, the Federal Reserve announced it would purchase up to $600 billion in mortgage-backed securities and agency debt. The goal was straightforward: push long-term interest rates down when short-term rates had already reached zero. Within months, the program expanded. Over the next 6 years, the Fed's balance sheet grew from roughly $900 billion to more than $4.5 trillion. The immediate crisis passed, yet the same purchases that stabilized banks and credit markets also drove sustained increases in the prices of stocks, bonds, and real estate, assets overwhelmingly held by higher-income households. The architects were Federal Reserve officials led by Chair Ben Bernanke. They drew on his own academic work on the Great Depression. After Lehman Brothers collapsed in September 2008, credit markets froze and unemployment climbed toward 10%. With the federal funds rate already at zero, conventional tools offered no further leverage. Large-scale asset purchases, modeled on earlier Bank of Japan experiments and on Bernanke's own historical research, appeared to be the remaining channel for lowering borrowing costs across the economy. Policymakers viewed the step as an emergency measure to prevent a second 1930s-style contraction, not as a permanent shift in monetary operations. QE1 began in late 2008 and was enlarged in March 2009. QE2 followed in November 2010 with $600 billion in Treasury purchases. QE3, announced in September 2012, added $40 billion per month in mortgage-backed securities and continued until tapering began in late 2013. At each stage, Fed statements emphasized that the purchases would support employment and price stability. Early data showed falling mortgage rates, rising home sales, and a stock market recovery. Critics inside and outside the Fed, including several regional bank presidents, warned that sustained purchases could distort price signals and favor financial asset owners. But the majority of the Federal Open Market Committee judged the risks manageable, given the depth of the downturn. Because the purchases directly increased demand for longer-term bonds and mortgage securities, their yields fell and prices rose. Investors seeking higher returns shifted into equities and real estate, lifting the S&P 500 more than 200% between March 2009 and the end of 2015. Home prices in many coastal markets also recovered and then exceeded pre-crisis peaks. Ownership of these assets is heavily skewed. The top 10% of households by wealth held roughly 80% of equities and 70% of real estate equity during this period. Wage growth for the median worker remained near 2% annually for most of the decade, while corporate profits and capital gains accrued disproportionately to asset owners. The resulting increase in the wealth-to-income ratio for the top 1% was documented in subsequent Federal Reserve distributional accounts. Lower borrowing costs also encouraged share buybacks and dividend increases rather than broad-based wage gains or new hiring in some sectors. Because the transmission mechanism relied on portfolio rebalancing, the policy had no direct lever to raise labor compensation once unemployment began to fall. Second-order effects included higher pension fund liabilities for underfunded public plans and increased housing cost burdens for younger households entering markets later. Third-order effects appeared in political discourse, as the visible divergence between asset prices and median wages reinforced perceptions that monetary policy primarily served financial markets. By 2014, the Fed began tapering purchases and completed the wind down in 2015, though the balance sheet remained elevated. Officials publicly acknowledged that the distributional consequences had been larger than anticipated. Minutes from 2013 through 2015 record repeated discussions of wealth effects. No formal reversal occurred. because reversing the purchases at scale risked renewed market stress. Instead, later frameworks incorporated explicit attention to financial conditions and labor market outcomes. The balance sheet expanded again in 2020 under different circumstances, but the post 2008 experience shaped internal debates about the limits of asset purchases as a long term tool. Today, the distributional footprint of large scale purchases remains a standing research topic at the Fed and other central banks. When a policy operates through asset prices, its benefits concentrate where asset ownership is already highest. Complex systems transmit interventions along existing distributions of wealth and information rather than along the channels designers most intend. Monitoring only headline employment or inflation can leave second-order effects on balance sheets and political trust invisible until they become entrenched. The episode invites us to ask, whenever a new tool is deployed at scale, which balance sheets will move first and by how much? That's unintended consequences for today. If this episode gave you something to think about, share it with a friend who'd appreciate the story. Subscribe wherever you listen, and we'll be back tomorrow with another case. And if you'd rather watch than listen, find us on YouTube at NARA Network. Links in the show notes. And before you go, this show is part of the NARA Network, a family of daily podcasts on tech, science, and markets, each one a short, sharp briefing you can finish on the commute. If today earned its place in your feed, here's your next listen. Environmental Intelligence, the Environment and Climate Policy Brief for Canada. Find every show free at naranetwork.com. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.